All right, BX4 back in the building, or in this case, back on your device. Thank you for coming back to this channel. We've got a lot of economic financial news to get caught up on here today. We've got big news with bank capital requirements. And if you know how the economy is appearing to look like it's strong and resilient, it all has to do with lending money out and people spending money. We're going to talk about the GDP number, but it could have a game changer coming up in October, at the beginning of October. And we've been talking here about things falling apart in October, possibly. It's looking like that's going to be the case still. And we've got a little more evidence to go over. We're going to talk about that here a little bit later. First, let's go ahead and get into the number, the big news headline out is that the economy grew and that everything is awesome. And this is faster than people, or more than people expected. It was stronger than expected. I'll bring up a quick snapshot here. U.S. economy, quote unquote, grew in the second quarter faster than initially thought. The economy is neither in recession or at risk of economic imminent end. Current business cycle. The latest reading, GDP report, came in at 3%. Estimated was 2.8%, so better than expected. The change was driven by personal spending, there you go, with an advanced 2.9% compared to prior estimates. So, folks, yes, government borrows money and spends it. It's GDP. It's considered economic growth. Spending and lending, folks, that's what's happening right now. This is all bank driven, right? If the banks pull back on the lending like they did in 2008, this whole thing comes screeching to a halt very, very quickly. And a lot of people out there just don't understand it. Investors are buying stocks based on this news, which is really not good news. When the GDP number comes out, I always look at it as bad news. If it's positive, it's bad. If it's negative, that's actually good. That means banks are contracting the loans, and that people don't have excess money to spend. In other words, people aren't able to spend money they don't have as easily when banks pull back on the spending. So when negative growth happens, when the economy is reported as being bad, that's actually good, because that means prices might start coming down, because the less money people have, the less borrowed money people have to spend, the cost of living then starts to come down. Prices of goods, products, services, it all comes down. Folks, this is all bank driven. Inflation, it's all bank driven. And we're going to talk about the banks here in a few minutes. So what do you think about the 3% GDP number put out there? It's put out there as positive economic news. We know they want to keep this economy looking really, really good, but there's a game changer here. We're going to get into that in just a few minutes here. But let's shift gears a little bit here into de-dollarization. A BRICS country, in this case India, will use cryptocurrency for trade and abandon the US dollar. So we have countries out there now more confident in the shady world of crypto. I say that as a joke because I actually hold crypto, but they're more confident using crypto than they are the US dollar. What does that tell you? As the BRICS bloc turns to alternative payment systems to ditch the dollar, India is likely to use cryptocurrency. They have completed its first crude oil transaction with the United Arab Emirates using local currencies. The transaction was integrated within the XRP ledger system, a big step for India towards future crypto integration. I told you guys years ago about XRP. That's one of the coins that I hold, and I think we're going to see something happen big time in the future for XRP. And they went through some legal troubles with the SEC. The powers that be were trying to stop that particular coin, because that's going to be used, very heavily used in the future financial system, in my opinion, and not just my opinion. Just do some research there, and I think you'll agree that some big things are ahead for that. So pretty interesting when you look at de-dollarization now with the banks. Let's talk about what's happened. We've got new capital rules being announced. Will they be enforced? That is the big question. Fed announces final individual capital requirements for large banks. I told you this was something that was on the table, and it's likely going to be implemented on October 1st. And what do we tell you here about the month of October? I think something else could come in and overshadow these banking changes. Something huge like a black swan, like a war, like a massive cyber attack, power outage, pick your poison. The Fed board unveiled the final individual capital requirements for all large banks and modified the stress capital buffer requirement. Under the new requirements, the minimum capital requirement is 4.5%. It says here the same for each bank. And let me bring up some highlights here. I've got it highlighted here out of the Fed's own site. The minimum capital requirement, which is the same for each bank, 4.5%. The stress capital buffer requirement, which is based in part on the stress test results. Now, here's where it gets important here. If a bank's capital dips below the requirement announced today, the bank is subject to automatic restrictions on capital distributions, folks. That's a word for loans, and that includes credit cards, that's capital distributions, and discretionary bonus payments. So could we see a big pullback in bank lending starting October? And again, October 1st. Red October, folks. What do you think about that? Or will there be no enforcement of this because the banks, again, are too big to fail? They're going to let the banks do whatever they want in order to keep the economy looking good. But remember, we've had a zero reserve requirement for several years, meaning banks could just loan out endless amounts of money, literally. Having zero in reserves and can loan out endless amounts of money. So this could it be a game changer? And will October be enough time for the economy to fall apart before November? We'll have to see. I'm thinking likely either this or something else, again, that comes in and kind of overshadows this, something even bigger, some sort of big black swan coming down here. So we're going to keep an eye on that for you and keep you updated on that. But we know that the key to this economic growth illusion that's being touted is ever increasing amounts of debt. As soon as the government can no longer borrow more money and go into debt, as soon as most consumers can no longer borrow more money and go into debt, this thing is done, folks. This economy is toast. And then you start seeing some deflation and the cost of living comes down. But then the downside of that is a lot of job losses, massive job losses, even worse than we're seeing now. Let's get into some other news here. I wanted to touch on this here. There's this whole narrative out there about how companies are price gouging. And that term has been really in the spotlight here recently in the news, with politicians out there saying they're going to stop these greedy companies from doing it. But here's the thing. Companies have been doing this for decades. What they're calling price gouging now is just using leverage. And when there's not much competition, companies can charge more. Look at Kroger now wanting to merge with Albertsons. That's going to create a bigger conglomerate, and it's going to be less competition out there. And so more competition is better. So if they want to stop price gouging, all they would have to do is make it easier for production to occur, make it easier for businesses to operate, to lower the overhead cost of businesses, including rent for warehouses, for just buildings for businesses to operate out of. But when you have the banking system behind it that's used funny money for decades now, of course you have high cost of living, high rents for stores and businesses, so that gets passed along to the consumer. If they were really serious about saving the consumer money, they would be looking at the source of the problem. Instead, they've been focusing on price gouging. So here's the latest on that. Kroger executive admits company gouged prices above inflation. They admitted gouging prices on selected items above inflation levels while testifying with the Federal Trade Commission attorney Tuesday. Kroger's senior director for pricing, Andy Goff, said the grocery giant had raised prices for eggs and milk beyond inflation levels. Well, here's the thing. Stores can charge what they want for products. And if people don't like the price, they're likely going to go shop somewhere else. That's called the free market. Do we have a free market anymore? It doesn't look like it, because now we have politicians out there saying they're going to go after businesses for quote-unquote price gouging. But who decides what price gouging is? Is $5 eggs price gouging? And then sometimes you'll go to a store that's more expensive because they don't carry a lot of food. Like, have you ever looked at the cost of eggs and milk in like a pharmacy, like Rite Aid? It's usually a lot more expensive. They're going to go after all the pharmacies for price gouging because they're so much higher than the grocery stores. See what I'm saying? So where does it end? This is a slippery slope, folks. And in other countries that this has been implemented, it actually lowered the number of businesses in operation because businesses had a new hurdle or a new risk, because now they had to have all these price checks to make sure it wasn't quote unquote above inflation. And that caused a lot of extra work, and they had to hire extra people. So it makes businesses less likely to want to go in business, or it makes businesses that are in business less likely to stay in business or want to stay in business because the risk, right? You have all these legal risks out there now. If they're going to go after price gouging, that's what they're saying. Drew, the founder of Illinois-based Powers Financial Group, told the Newsweek, companies across multiple industries have been posting record profits since the health crisis, while consumers have faced the highest inflation in recent history. The math can only point to companies raising prices above the general level of inflation. As the old saying goes, never let a good crisis go to waste, what they say. Folks, this is called business. And if they really wanted to get to the source of the problem and make things easier for consumers and make prices come down, all they would have to do is limit the bank lending, go back to a sound source of money. Of course, they're never going to do those things. So they're always going to find a different scapegoat, right? Corporate greed, what's called greedflation. Now they're calling it price gouging. And will people fall for it? I mean, will people vote to go after businesses for price gouging? And will that actually help things? I think it's going to make things much worse. Please let me know what you think about that down below. In the countries that I've seen these types of things put in place, inflation has gotten much worse, and more stores went out of business, and it was less enticing for people to start up a new business because of that, because of the higher risk in that. But a lot of the other countries that had capital limits and had these types of limits in place for businesses saw big time inflation problems. We'll have to see how this works out, if this ends up being something that gets enforced. All right, let's move over to real estate. We know that unaffordability is the worst that it's ever been, worse than the peak and the most dire point of the housing bubble, 2007, 2008. And what's happening, not only are prices higher, but home sizes are also getting smaller. U.S. homes aren't just more expensive, they're also getting smaller. Looks like this person sitting here drinking some coffee. Looks like an RV home there. It's pretty narrow. But yes, that's what's happening, folks. So not only are prices higher, they're even smaller than they were back then, and they've gotten smaller throughout the years on average. Now, of course, there's still big homes being built, but the average home size has decreased. So you're getting less for your money and you're paying more. Another hidden source of inflation, folks. Also, we have a big drop in mortgage rates. And we told you this was likely going to happen just a couple months before the end of the year. So here we are almost in September. We're almost in the third trimester of the year. And this is the time where we're talking about rate cuts. We told you this back in January. You're likely going to see rate cuts. Fed's talking about cutting rates in September. It's looking like it's almost a sure thing that there's going to be a rate cut. But not only that, we've got a big buyer of debt. And we see the 10-year bond yield has dropped. We see mortgage rates have dropped to the lowest now in about a year. Again, no surprise to anyone here on this channel. And I think what they're trying to do is keep this housing bubble inflated. We talked in our last report. We've got tens of millions of people now that are likely going to get down payment assistance programs in multiple states. And these are people that are not even here, not even citizens. So that's the craziest part. I see my last report on that. But here's what's happening with the housing market. We see the spike in inventory, and we're now at pre-2020 levels. Right? So this has been an uptrend now for the past few years, and we are seeing some things change or shift in real estate. And this is with all the rescue programs, all the ways they're trying to keep home prices propped up. But now we got the new bank capital requirements hitting in October. Will that be the rug pull, or will that just be masked by some other rescue program or some other way to keep the bubble inflated? Either way, very interesting times here. Very important times to pay attention, stay ahead of the financial curve. Do I have any more today that we want to get into? Actually, those are the biggest stories I had for you for today. What do you think about all of this? Please let me know. Please let me know what you think down below. The 3% GDP, which always comes with more spending and more debt accumulation. When debt drops, the GDP drops, then prices come down. But we're not going to see that happen. It's going to be more inflation. It's going to get harder for the most part for most people. Everybody, thanks for watching. Keep stacking. Bye for now. Peace.